All right, everybody. Welcome to this week's episode of DoubleLine Minutes. I'm Eric Dhall here with Mark Kimbrough.
Hey.
It's 10:47 a.m. Pacific on April 17th, the day before Good Friday, traditionally called Mandy Thursday, and short week. The bond market's already going to be closing in 13 minutes. The stock market's going to be closed tomorrow as well as the bond. So it's been a pretty interesting week in the sense that maybe a bit of calm interspliced with the volatility that we've been experiencing recently in markets. So let's just jump into it and make it a quick one for all listeners out there. So on a week-to-date basis, the S&P 500 is down about 90 basis points. And the best performing sector was energy, up about 4.5%, followed by real estate, up over 4%. And utilities up about 3%. The laggards this week were the technology sector, down about 2.25%, as there was a lot of talk regarding semiconductor tariffs impacting the finances of some of the big players there. Consumer discretionary down 2%, and healthcare is also a loser, down about 0.5%. There was some big news about a major health insurer that their profitability is looking suspect and their stock's down over 20% today. So that kind of gives you the overview on how the sectors did this week. Looking at the growth stocks are down about 2%, while value stocks are actually up about 70 basis points. So that's a interesting thing to note. And the S&P 500 equal weight is actually up over 2%. So another interesting thing to note week to date. Moving over to fixed income land, it's been a positive week in fixed income land. The U.S. aggregate's up about 90 basis points on the week. We're in looking at the sectors. Pretty interestingly, the best performing sector was emerging market bonds, up about 2.5%, followed by high yield bonds up about 1.5%, and the rest of the bond market's pretty much in line. But looking at corporate bonds up over 1%. Mortgage-backed securities up about 90 basis points, and government bonds up about 80 bips. You look at the yield curve had a little bit of motion, but it was mostly intra-week volatility. Um, the 10 years down 17 on the week, 30 years down 7, 3-month is flat, the 2 years down 17, the 5 years down 22 basis points. But I'd say it was more of a bumpy ride than a huge secular move, but those are the prints. The commodity market had a bounce up 1.5% on the broad Bloomberg index. When you look at the sectors, the best performing sector was livestock. Precious metals also up 2.5%. Industrial metals with a rally up 1.75%, and energy with a rally as well. As we sit here right now, the oil market is looking kind of a little more stable. WTI crude's at $65, and Brent crude is at similar levels, $68. So that's kind of where the oil market's at. Looking at gold, everybody's favorite pet rock, it's sitting there at $3,309. So the rally in gold this week, and that's kind of rounds things out for the week. Pretty quick week.
It's a quick week, but I mean, just the way you ended that with commodities and bonds on the way up, I mean, you might as well, it feels like equities were up, even though they were down that little, 80, 90 bips or so on the week. But hell of a change of a week, given the volatility we've seen the last couple.
Yeah, I think the market's a little shell shocked. The market has some volatility, uh, post traumatic volatility syndrome, perhaps. So, maybe some consolidation right now as the market tries to digest the constantly gyrating trade talks and all the other happenings. But let's just jump into the macro and see what printed.
All right. Well, you know what? It's a pretty light week here on the macro front, so we'll run through it kind of quick here. Start off on Tuesday, we got import prices for the month of March. In general, pretty nice prints here. We had everything coming in below estimates, and everything calmed down from the month prior. But let's run through some numbers here. The month-over-month print for the headline came in at -0.1. That was 0.1%. That was 0.1% below the estimates and 0.3% below the prior. That led us to get a year-over-year number that printed at 0.9%. That was 0.5% below the estimates and 0.7 below the prior. Also give up the import prices, ex-petroleum. That was flat on the month. That was 0.3% under estimates and 0.1% below the prior. And that gave us a 1.6% year-over-year figure, which was a 20-point dip from the prior. In general, hey, look, if I was just to take this on its surface, I'd say not much to see here. This is pretty nice to see kind of disinflation / flat prints for the month. I mean, if we didn't have to talk about tariffs, I would say just wrap it up, and that's nice there. Some things I want to point out, though. We've talked about this. We've given the reminder periodically. Import prices have no sorts of adjustments. These are nominal figures, non-seasonally adjusted numbers. As we find out wherever tariffs settle, this is not going to include the direct impact of tariffs. And in the event that exporters start to try and, eat some of that tariff cost, we actually can see deflationary prints here. So just something to keep in mind is these numbers, if they come in soft, that isn't to say that we're having deflation coming through. It could be a little noisiness from the impacts of tariffs. And we need to look more just at the CPI and PPI for a forward look on inflation, or I guess, rear view look. But when we're using import, we're trying to get ahead of the CPI and PPI. But maybe just this isn't going to have as much usefulness in the months to come. But of course, we will continue checking it. Moving forward to Wednesday, we have retail sales for the month of March. Strong prints. There's some caveats here, some kind of hand waving we can do, but I'm going to say the numbers are strong. The headline print came in at 1.4%, right in line with estimates, and a firm 1.2% above last month. You have the ex-auto and gas number came in at 0.8%. That was 0.2% above the estimates and right in line with last month. And lastly, you have the retail sales control group, the one that hits GDP. That one came in at 0.4%. That's 0.2 below the estimates, 0.9 below the prior. Again, these numbers
Now,
as a
what
whole
would you
look pretty
say,
strong.
Mr. Kimbrough? What would you say to a skeptic who retorts, "Well, that's all just pre-tariff buying, and it's just not a bullish report because it's all just people scared stocking up."
Look, I'm going to give you some numbers that support that and some numbers that go against that, because I understand that people can make that claim and it's not irrational. This month, 20% of the retail sales report comes from vehicles and parts, 19.6. That contributed 104 bips of the 143 bips this month. That's looks, you could say, hey, that's a strong month. This actually was the largest month-over-month print. It was up 5.3% month-over-month. That's the largest month-over-month print we've had since January of 2023. I'll use another one. We got building materials, something you can understand. Maybe there'd be a little front running of tariffs. About 6% weight in the index, was up 3.3% on the month. Largest print since we seen in March of 2021. And in general, the report had 11 of the 13 categories were up. And if you just wanted to say tariff front running, and you could say that, and you wouldn't be wrong, you wouldn't be right. We'd find out later on down the line. But there's another category in there to push back on this. Eating and drinking, services, 13.4% weight, was up a reasonable 1.8% this month over month. I mean, that's actually, shouldn't say reasonable, that's quite firm. In fact, it's the firmest print we've seen month over month for this loan service category since January of 2023. So while the whole report you can say is quite strong, and you can try and deflect a little bit of it saying it's front running, the services category, that's not front running. That's maybe a little pent up demand from some weakness to start the year, but that's a very firm print from our loan services read in this report. So there's a little of something for everybody in here. But I would say that, yeah, look, if you're taking the narrative of front running, then yeah, look, you can say that maybe there's going to be a little void in the future. We've pulled some demand forward and we got to be prepared for that payback. But I mean, it's still, this is the hard data set, and the hard data set is still printing strong.
Yeah, I think that's a good point. We got to pay attention to the hard data, and I think more specifically, we have to pay attention to the hard data that comes out next month in May after,
Agreed.
because people have been shocked by, the changing dynamics going on in the marketplace. And so we really need to wait for the May data. That's my opinion. So how about the rest of the week?
No, let's wrap it up. Actually, we got 2 more days here. On Wednesday, actually, I'm going to try and paint this in a positive light. We had industrial production for the month of March. We got capacity utilization, and then the manufacturing production that excludes minings and utilities. So let me run through a couple numbers here. The industrial production for the month of March printed at negative 0.3%. That was 0.1% below the estimates and 1.1% below the prior. In no way does that look good on the surface, but we'll get into it. Capacity utilization came in at 77.8%, 0.1%, 0.1% below the estimates, 0.4 below the prior. That's not a positive number either, not looking good. But the manufacturing production that excludes mining and utilities came in at a positive 0.3%. That was 0.1% above the estimates and sadly 0.7% below the prior. Now, at the surface, again, none of this looks booming, but I want to say that most of the weakness in the headline number, the IP, was coming from utilities. I'm going to give you the breakdown here. You got manufacturing. The vast majority of this index was up 33 bips on the month. Mining was up 67 bips on the month, and then utilities was down, thanks to some unseasonably warm weather, was down 5.8% month over month. So again, it's somewhat of a weak print, but if I just want to focus on the manufacturing sector alone and talk about its 33 bips, I actually want to look at the entire first quarter and say that it was up a cumulative 144 bips in Q1, which is actually the strongest quarter we've seen for this particular manufacturing indicator since the fourth quarter of 2021. So we've been looking for, signs of some thawing here and, seeing dribs and drabs of it. Again, there's noise in this data. We're going to need to look forward. A lot of the stuff backward looking from March behind. You don't want to put too much stock in the trend that we're on, given all of the gyrations going on with trade policy. But it's still, this is hard data and it is positive. So I will say that's not too bad.
I think that's a good point. The first quarter looked somewhat positive for manufacturing. We'll have to wait and see how the trade disruptions flow through.
Yeah.
And, nothing to see in the jobless claims, came in at 215,000, almost flat. If you look at the moving average, we were discussing on the trading desk this morning, it's flat as a pancake. There's almost no slope to that line. It's just flat. So I'm gonna say nothing to see there. Continuing claims, same story, came in at 1,885,000, but just no signals from there. So I'd say the most market moving thing that happened this week came from Jerome Powell speaking in Chicago yesterday, and we have a couple quotes we'll throw in to kind of give our listeners an update there. But long story short, Powell's just sitting on his hands. Why don't you read off those quotes, Kimbrough?
Let's get the primary one I wanted. Of course, my screen just went away. Here we go. So, quote, "For the time being, we are well positioned to wait for greater clarity before considering any adjustments to our policy stance," end quote. I'm going to give you one more. This is, quote, "Tariffs are highly likely to generate at least a temporary rise in inflation. The inflationary effects could also be more persistent. Avoiding that outcome will depend on the size of the effects, on how long it takes for them to pass through fully to prices, and ultimately on keeping longer-term inflation expectations well anchored," end quote. I mean, it's the market reaction to Powell's moments here and some of the sound bites.
Huge sell-off as soon as he started talking about this stuff.
That's the biggest bout of volatility we saw all week was post Powell comments right there, saying, he's not coming to the rescue. At least
definitely not. And looking at the interest rate probabilities, I mean, the chance of a cut and lay has dropped now to around 10%, and still holding above 50% for June, but we'll have to wait and see. And one other thing we had discussed on the desk today is, so short-term, just to recap, short-term interest rate relief isn't likely to occur. So the stock market didn't like that at all. But, we're starting to see talk of the shadow Fed stuff coming up again. I mean, the President of the United States trashed the chair of the Federal Reserve today. And, there's talk that Besant, was saying that they're going to be bringing out candidates in the fall. So, you could see the next Fed chairperson being a kind of puppet there to kind of maybe implement forward guidance from the outside of the Federal Reserve. Who knows? But we have to wait and see what happens.
I love that this came up just because me and you were talking about this on the desk on Tuesday, and it was just saying this topic of the future of the Fed has kind of fallen off the news cycle. And it was just saying it's going to come back at some point. And lo and behold, it took 2 days. Now that the news is hitting, and here we are.
Yeah, here we are. So let's look at the week ahead.
Very light week as well next week. On Monday, we got leading the LEI, leading economic index. It's estimated to come in at negative 0.4%. The year-over-year number with a negative 0.2 roll-off would bring us down to negative 3.3. It's a 5-month low. Also on Wednesday, we get the S&P Global U.S. manufacturing and services PMI data and composite. I didn't have any estimates this morning yet, but last month, all of them were still in expansion. So we'll see how that goes. This is the April data. Also on Wednesday, you get the Fed releasing the Beige Book, This is their third release of 8 this year. Just good qualitative data. We'll check in on that. Also on Thursday, we get some manufacturing data to kind of corroborate what we just talked about this week. We have durable goods orders and the ex-transportation figure. Headlines expected to come in at 1.5% for March. It's half a percent above last month, above February. But more importantly, the durables ex-transportation number, the headline number is rather volatile, but that's estimated to come in at 0.3%. That's 40 bips below the prior. And then Thursday, we get our high frequency, just weekly jobless claims. No estimates yet, but we'll see how that comes through. No expectation for anything major. It's been steady, she drifts. And that's a kind of quick week next week.
Yeah. I don't know if we got the record for the quickest episode of DoubleLine Minutes today, but that kind of wraps it up on a short week. And hope all of our listeners enjoyed the recap.
Yes, thanks to our listeners out there today on DL Minutes. You can hit us up on the X at DLine Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
You can find more information about DoubleLine on our website, doubleline.com. Don't forget to subscribe to our YouTube channel at youtube.com/doubleline capital and check out the content. And so once again, thanks. Wishing all of our listeners, happy Holy Thursday, happy Good Friday. Hope you have a good weekend. Hope you have a great Easter with your family. And we'll hear from you guys next week.
Yeah, enjoy the weekend, everyone. Take care.